Look around. The headlines are screaming about a soft landing. Every financial channel is showing you a stock market at all-time highs. The Federal Reserve is whispering about rate cut. Everyone thinks they dodged the bullet. They think inflation is handled. They think the system is returning to its comfortable, low-rate normal. But here's the dangerous truth that Wall Street is terrified to admit. The Fed didn't kill inflation. They just moved it. They didn't solve the problem. They simply pushed the pressure from one area of the economy to another, paving the road with trillions of dollars in new debt and printed money. And now they've set a trap. It's not just a debt crisis you should fear. That's old news. It's a wealth erosion crisis hiding in plain sight. Every financial advisor on TV is telling you to buy the dip. I'm telling you there are 3 specific assets you must sell and liquidate now before the year ends, or you'll be the one paying the price for the Fed's success. Let's be clear about the inflation trap. This isn't the fleeting, transitory inflation of last year caused by supply chain glitches. We are looking at a permanent, structural shift. The government is trying to pay for last year's historic spending spree with this year's dollar, but that dollar is worth less and less. This isn't a booming economy. It's a financial quicksand. The trap is this: assets that worked brilliantly for the last 10 years are about to become dead weight in this new reality. The real rate of inflation, the one that hits your pocket every time you buy gas or groceries, is still dramatically higher than the interest rate you get on your savings. You are losing money just by holding on to the wrong things. We are entering an era of structural, sticky inflation fueled by 2 massive, undeniable forces: a deglobalization reset causing supply chain costs to permanently rise, and labor market tightness driving up wages faster than productivity can keep up. Analysts predict these forces alone could add 0.5 percentage point to baseline inflation for the next decade. This is not temporary. Now, let's identify the sacrificial lambs. The first asset you must sell is overvalued, high-priced earnings, PE, tech stocks with thin cash flow. We call this the tourist trap. These companies are built on borrowed time and cheap capital. They thrived when the interest rate was near zero because the future value of their massive growth promises was worth a fortune. But in a high inflation, high-rate environment, the cost of their future growth explodes. Right now, many large tech companies are still trading at PE ratios well over 35, substantially higher than the historical average. This is a valuation built for the past. They are paying for yesterday's debt, and they are priced for tomorrow's perfection. Any economic hiccup, any sign that their massive investments in AI don't pay off immediately, and the market will finally, brutally, reprice them. You must sell the dreamers. The companies that rely on borrowing to survive are about to get crushed by the rising cost of debt. Their future growth isn't worth the paper it's printed on. Their stock price is a tourist trap built on yesterday's cheap money. When capital stops being free, the dreamers become the first victims. The second asset you must sell, right now, is long-term fixed-rate government bonds. We call this the zombie asset. For decades, bonds were the most common financial safety net. Not anymore. Now, they are a major liability. You are buying a 10-year IOU that promises to pay you back in devalued dollars. Inflation is a bond's worst enemy because it ruthlessly erodes the purchasing power of that fixed payment. Bonds are supposed to be safe, but in this environment, they are a zombie asset, already dead, but still walking in your portfolio. You are guaranteeing yourself a loss of real purchasing power. Look at the history books. During the great inflation of the 1970s, bond investors were devastated for a decade. Why? Because the nominal interest they received was easily outpaced by the accelerating cost of living. You are losing money just by standing still. The longer the term of the bond, the more risk you are taking. You need liquidity and protection. You must liquidate these positions. Don't be the sucker holding the paper when the inflation music stops. The third and final thing you must sell is passive, low-yield real estate investment trusts, or REITs. especially those focused on non-prime commercial property. We call this the sucker's bet. The basic financial advice is, buy real estate to fight inflation. That's the basic advice. But you need to sell the fat. Not all real estate is equal. While core tangible assets will perform, low-quality REITs are over-leveraged and staring down a debt maturity wall. This year alone, close to $1 trillion in commercial real estate loans are coming due, forcing refinancing at cripplingly high rates. The data is screaming. Commercial mortgage-backed security delinquency rates are surging, hitting over 7% in some sectors. We're seeing office vacancy rates in major cities hovering near 20%. These are the properties that back those low-quality REITs. Their costs are exploding due to high interest rates, and their revenues are collapsing due to structural changes like work from home. You get low yield and high risk. This is the sucker's bet that gets liquidated first, when the cracks in the consumer foundation finally spread. You must liquidate your exposure to this fragile paper asset class now. This is not about market timing. This is about acknowledging the fundamental shift in the economic machine. The inflation trap is real. It will silently devour the wealth of those who are holding assets built for a world that no longer exists. You now know the truth that Wall Street is ignoring. You have the roadmap. The clock is ticking. You must liquidate these 3 positions. The trap is set. Don't be the one caught in it. Subscribe so you don't miss the escape plan.